Leo has watched stock prices move for 2 years. Up, down, up again. He has felt emotions about these movements. Strong emotions. He did not know what he actually owned. He knew the ticker symbol. He knew the price. He did not know what the company did. He did not know how it made money. He did not know why the price moved. He was essentially betting on a number, while believing he was investing in a business. These are not the same thing. Leo learned this the hard way. You don't have to. Here's what most people think a stock is. A number, a ticker symbol, something that goes up when good things happen and down when bad things happen, for no reason anyone can explain. That understanding, vague as it is how the majority of retail investors approach the market. FINRA, the Financial Industry Regulatory Authority, found that only 34% of Americans could pass a basic financial literacy test covering stocks, diversification, and market risk. 34%. 2/3 of the people investing in stocks don't have a working understanding of what stocks actually are. Leo was in that 2/3. Leo had opinions about stocks. Leo had feelings about stocks. Leo did not have knowledge about stocks. Here's what changed when he finally understood what he was actually buying.
Yeah, boy.
A stock is ownership. That's it. When you buy one share of Apple, you own a tiny fraction of Apple Inc. The buildings, the intellectual property, the revenue, the future earnings. A piece of all of it. Not a big piece. Apple has roughly 15 billion shares outstanding. One share is roughly 1/15 billionth of the company. Leo finds this both humbling and oddly motivating. But here's why it matters. In 1980, Apple went public at $22 per share. One share, $22. After accounting for every stock split since then, that original share represents hundreds of shares today worth collectively over $20,000. Not because someone got lucky, not because a number on a screen went up for no reason, because the underlying business, the thing that share represented, grew into one of the most profitable companies in human history. The price followed the business. It always does. Eventually. People who understood that held through every dip, every crisis, every moment the price moved for reasons that had nothing to do with Apple's actual value. People who thought stocks were just numbers sold at the wrong time. Every time. If this is already reframing how you think about this, Leo has more. Subscribe so you don't miss what comes next. Here's the misconception Leo held for embarrassingly long. You make money when the price goes up and you sell. And yes, that's one way, but it's not the only way. And depending on what you own, it might not even be the main way. Stocks can make money in 2 ways. Leo calls this the return pair. First, price appreciation. The business grows, earns more, becomes more valuable. The price reflects that over time. You sell for more than you paid. That's the one everyone knows. Second, dividends. Some companies, particularly older, stable ones, distribute a portion of their profits directly to shareholders. Cash. Paid to you. Regularly. Just for owning the stock. Coca-Cola has paid a dividend every single quarter since 1963. Through recessions, through market crashes, through every economic disaster of the last 60 years. Warren Buffett's Berkshire Hathaway owns so much Coca-Cola stock that Berkshire receives over $700 million in Coca-Cola dividends alone every year from shares purchased decades ago. That is the business of owning businesses, not watching numbers. The difference between people who built meaningful positions over time and people who just traded prices was usually that the first group understood what they owned. The second group understood what the price was doing. Those are different games, with very different outcomes. Here's the part that trips everyone up. If a stock represents a real business, why does the price change every single minute? The business doesn't change every minute. Apple's revenue doesn't update hourly. McDonald's isn't selling more burgers because the stock ticked up. The price moves because of people. Not the business, people.
Okay.
Their expectations, their fear, their confidence, their reactions to news. All of it hitting a market simultaneously, every second the market is open. Benjamin Graham, the investor who taught Warren Buffett, described this with a concept he called Mr. Market. He said, imagine the stock market is a business partner named Mr. Market. Every day Mr. Market shows up and offers to buy your share or sell you his. Sometimes he's euphoric and offers a price far above what the business is worth. Sometimes he's terrified and offers a price far below, The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. In plain language, Mr. Market's mood is not your problem. The business underneath is your problem. If the business is sound, Mr. Market's bad days are not a loss. They're a sale. Leo sold during one of Mr. Market's bad days. Leo is not going to tell you exactly how much that cost him. So if a stock is a business, how do you actually evaluate whether that business is worth owning? Leo now asks 3 questions before buying anything. He calls this the business lens. Question 1. How does this company make money? Not what it sells, how it actually generates profit. Apple makes hardware, but its highest margin business is services, subscriptions, App Store fees, iCloud. If you didn't know that, you didn't know what you owned. Question 2. Is it making more money over time or less? Revenue growth, earnings growth. A company that earns more each year is worth more each year. That's not complicated. What is complicated is separating genuine growth from accounting decisions, which is why Pew Research found that investors who read at least one earnings report before purchasing a stock held their positions significantly longer and sold at significantly better prices than those who didn't. Question 3. What could kill this business? Not pessimism, risk awareness. Kodak was the most dominant photography company on Earth in 1990. They actually invented digital photography, then chose not to pursue it, to protect their film business. By 2012, they filed for bankruptcy. The business model was the risk. The price followed. Slowly at first, then all at once. The business lens doesn't require an MBA. It requires asking what a business actually is before you give it your money. Here's what changed for Leo once he understood what stocks actually were. The price chart became less interesting. Not unimportant, less interesting. Because the chart is just Mr. Market's daily mood. The business underneath is the actual investment. The Federal Reserve's Survey of Consumer Finances consistently finds that households with the highest long-term investment returns share one behavioral trait more than any other. They held longer. Not because they were fearless, because they understood what they owned well enough to not be frightened by someone else's fear. A number on a screen goes up and down. A business compounds quietly in the background, whether you're watching or not, whether Mr. Market is happy or not, whether Leo is checking his portfolio every 14 minutes or not. Leo has stopped checking every 14 minutes. He's down to 11. You've spent years watching prices. Try spending 1 hour understanding one business. See which one tells you more. I hope you liked the video. Don't forget to subscribe. See you in the next one.